Hello viewers, we were discussing about the theoretical part of options in the first two videos in options understanding series. So from this video onwards, we will be discussing about different strategies that one can deploy based on the market trend. Okay, so in this video, we will be focusing on bullish setups using single and two-leg strategies. Market can be either bullish, bearish or sideways. We will cover strategies covering all three scenarios, but in this video we will focus on bullish setups. Okay, so as part of this video, these are the topics that we will be covering. So we have 4 strategies in total. Buying a call with cover. Since we are bullish and we are using a call option, this is called bull call spread. The third one is selling a put. Fourth one, selling a put with cover. Since we are bullish and we are using a put, so this is called bull put spread. Okay, before we go further into details, I'll just talk about this book, Art of Stock Investing. So this is a book mainly focusing on long-term wealth creation, on identifying companies which are making profits year after year, and how to build a portfolio. So this is for long-term investment, nothing to do with trading. And if you want this book in the PDF format, kindly provide your details in the link available in the description of this video. Okay, now let's get started. Okay, buying a call. Rather than just buying on random, you should know when there is a bullish sentiment. You should have your own trade setup. Like either you should be able to identify a breakout, or you should be able to identify a trend reversal. This is because you are buying an option. So for option buyers, time decay is against you. So as the number of days is going on towards the expiry, the premium will decay. So you need momentum. When you buy an option, let it be call or put, if there is no momentum in the direction, then the premium will fall. Most likely you will end up in losses. So you need momentum. So look for a breakout or a trend reversal before you actually buy a call option. So what is the maximum loss one can incur? Whatever premium that you pay will be the maximum loss. Maximum profit unlimited, but this is theoretically. So we will just discuss this in detail with an example. The selection of strike matters if you are planning to hold it till expiry. When you select a strike which is closer to the current spot price, it will be costly, meaning you will have to pay more premium to buy that. The capital required is higher, but the probability of that becoming in the money is higher than you buying a far away out of the money call option. Okay, so now let us discuss with an example. So I'm going to select say Sun Pharma. Let us take a monthly chart of Sun Pharma. You can see it was in a major bull run till 2015, and then it had a bearish trend. Now again it turned bullish. But the point to note here is we are looking for a breakout, not for a trend reversal. Trend reversal also you should have entered somewhere around here, but now we will look for breakout. You can see this is a high that was made in 2018 August. Again from there it started to fall, but this time you can see here the previous month, that is April 2021, it closed above 650, and the entire pharma space is bullish now because of the current corona situation. So one can assume, since it's a breakout above 650 a monthly close, potentially one could have gone long there. Okay, if you want to go long, say on Sun Pharma, since it's a breakout, assuming the breakout is happening now, though it happened at 650, so we'll just take this as an example. Let us go to Strategy Builder. I'm using Sensible. If you are planning to subscribe to Sensible, you can get the discount code that is available in the description. Okay, I'm going to look for Sun Pharma. Okay, so here you can see the ready-made strategies that is available. Bullish, bearish, neutral, all that. So we are bullish and we are going to buy a call option. You can see here, buying a call, by default it gives you one strike price. Let us take the same strike price, that is 700, and the current price is 702.85. This is just at the money. and the expiry is 27th May. It's a monthly expiry. How much you have to pay? 34,720. That is the premium into the lot size. So if you are bullish on Sun Pharma, you go ahead and you are buying the call just at the money call, hoping the bullish trend will continue, the momentum will be there. That is your assumption. So what is the maximum loss? 34,720. What is the maximum profit? Unlimited. That is because as the price keeps going up, you will make money till the expiry. You need to understand when you trade in options, what is the break even? Here the break even is 724.8, meaning you will be in profit only when Sun Pharma expires by end of this month above this price. How this price is arrived? The strike price plus the premium that you paid to buy that call option, that is 700 plus 24.8. So this is your break even point. And they have something called POP, that is probability of profit, that is 37%. Okay, so this is simply buying the call option. Now let us go to the next one. Buying a call with a cover reduces the loss in case of expectation going wrong. Say our assumption is Sun Pharma is going to go further high and we were anticipating it will settle above 725. What if Sun Pharma doesn't go there? Either it becomes sideways from 700 or it drops. Then we have a bigger loss, that almost 34k. So by buying a cover, you can reduce the loss. How? I will demonstrate in that tool. You will see the rest of the points as well. But it is going to limit your profit beyond a point. Earlier, the profits were unlimited. But when you take a cover to reduce your loss in case the market, the price don't move in your direction, so we took a cover. In case if the price moves in your direction and if it goes beyond the strike price where you took the cover, then your profit will get fixed at that point. But this increases the probability of profit by lowering your break-even point. So let us check that. Here I am going to sell let us say I am going to sell 740 call option. Now you can see my maximum profit from unlimited got reduced to 36,960. You can see the maximum loss. Earlier it was 34,000. Now it is only 19,000. That is because I have collected this much premium. 11 into 700, whatever the strike price that is. This is the lot size. Okay. Now you can see the probability of profit increased from 37% to 44%. The main point to check here is your break even got reduced from 724.8 to 713.6. See, all this will hold good assuming you are planning to hold your option till expiry. You can get out of your position anywhere. Even for example, on the next trading day, if Sun Pharma goes like 2%, 3%, this call option will proportionally increase. You can just exit there. And you need not wait till expiry. So all this break even, the maximum profit, maximum loss, the entire thing is under the assumption that you are planning to hold till expiry. Okay. Now we discussed about buying a call and then buying a call with a cover. This is from buyer's point of view. If you are bullish, rather than buying a call, you can sell a put option, because when the price goes up, the underlying price, the puts will go down, the put premium will go down. And what is the difference between option buying and option selling? If you don't know, please watch the second video where I have explained in detail with an example on different scenarios why option selling is more probable of getting profit than option buying. But there's a risk associated in it. Without understanding the risk, never sell an option. Maximum loss, that is unlimited theoretically, because when you sell an option and the price goes against you, your losses will keep increasing. Maximum profit is limited here. That is how much our premium that you collected when you sell, that is your maximum profit. You need more capital to sell an option because of the higher risk. So if you don't know, or if you don't know how to manage in case the position goes against you, never sell an option, because you will lose a lot of capital in this. But it has higher probability to make a profit. Now let us again see an example. Okay, so here, now we are bullish. Now let us sell a put option. You can see here, again by default this has brought me 700, so let me go 1 point lower. Here you can see now the put premium is around 13, so I am getting a premium of 18,340. What is the maximum loss? It is giving a theoretical maximum loss if Sun Pharma going to 0 rupees, which will never happen, but still that is the maximum loss that you can get. My maximum profit is limited, that is equal to the premium that I am collecting. But the point to note here is, what is the probability of being profit? That is 71%, whereas in buy it was 37% and with the cover it was only 44%, but here the probability increased to 71%. And you can see the break even. I will be in loss only if Sun Pharma goes below 676.9, though the current price is 700. Assume it settles at 680, which is 20 rupees less than the current price. Though I am bullish, still I will be profitable. So that is why selling is always more profitable than buying. So which you can know in detail in the second video of this playlist. So this is on selling a put. Now let us see how to do with a cover. Sell put with cover, that is you are bullish and we are creating a spread using put. It reduces the loss in case of expectation going wrong. We were bullish and the current price is 700 and we wanted to sell a 690 put in case if our anticipation goes wrong. Because of heavy FIA selling, Sun Pharma is going, entire market goes down and Sun Pharma also goes down to say 650 or 640. Then you will be incurring heavy loss. But when you take a cover, it will reduce your profit, but it will reduce your risk. So the margin required also will go down. Let us see this. You can see how much funds needed. The funds needed was 2.12 lakhs to sell a put option. Now I am just going to add a cover. You can see the changes here, the probability, the maximum loss, maximum profit, break even, funds, everything will change. So assume I am taking a cover here. I am taking a buy. My maximum profit reduced from 18,000 to 13,000, but my max loss also from 9 lakhs, it came down to 42 lakhs. The 9 lakhs is theoretical, you forget about that. Break even increased from 676 to 680 because I am paying 3 rupees to buy this put option. So my funds needed from 2 lakhs, it reduces to 93,000. So you get the advantage of containing your risk and you also get an advantage of reducing the margin that is required for you to take this trade. That's why like most people go always with a spread rather than going like naked buying or naked selling. Okay, so I hope I have explained these 4 simple strategies for a bullish setup. In the next video, I will be explaining about bearish setups. Thank you for watching. Please subscribe to our channel to watch more videos.